Good morning, everyone. Thank you for joining this discussion on economic trends and tax policy implications. My name is Alexa Kramer, and I have the privilege of serving as Director of Government Affairs and lead staff for the Tax and Regulatory Affairs Committee for your Grand Rapids Chamber. Today's town hall is brought to you by the Chamber's Tax and Regulatory Affairs Committee. The committee is one of the 5 issue committees our Government Affairs team staffs. Other ones include Education and Workforce Development, Healthcare and Human Resources, Transportation, and Environmental Affairs. If you would like to get more involved in our work and help craft our legislative priorities, we encourage you to connect with a member of our team. Chantel is going to drop the committees and email addresses of the Government Affairs staff member that leads each committee in the chat. We would love to have you at the table. Today, we'll hear presentations on national economic trends and what this means for federal tax policy along with state and local funding. We'll also get to hear the latest and greatest on the Paycheck Protection Program. Before I introduce today's speaker, I'd like to share a few ways you can engage throughout the event. Today's program is best experienced on a laptop or tablet. If you are joining us by phone, visual presentations may not be easily viewed. You will have the opportunity to submit questions throughout the presentation using the chat function. Our speaker and panelists will address as many as time allows during the Q&A session and at the end of the presentation. Should you experience any technical issues, please send a direct chat to the Grand Rapids Chamber. A member of our staff is standing by to assist. In addition to the work of our Tax and Regulatory Affairs Committee, today's webinar would not be possible without the support of our 2021 Government Affairs underwriters. Please give them a warm virtual round of applause. Our advocacy underwriter is Amway, and our advocacy supporters are AT&T Michigan, Blue Cross Blue Shield of Michigan, and Priority Health. Let's go ahead and jump in. It's been about a year since we've heard from an American Enterprise Institute expert, and as you all know, a lot has changed in a year. Most of you probably already know this, but I am a huge AEI fan / nerd, and I'm very excited to have with us Kyle Pomerleau, resident fellow at AEI. Kyle studies federal tax policy, and before his time at AEI, he was chief economist and vice president of economic analysis at the Tax Foundation, where he led the macroeconomic and tax modeling team and wrote on various tax policy topics, including corporate taxation, international tax policy, carbon taxation, and tax reform. Kyle has been published in trade publications and numerous policy journals and is frequently quoted in the New York Times, the Wall Street Journal, and the Washington Post. Kyle is a fellow MPPer. He is his MPP in Economic and Social Policy from Georgetown University and a BA in History and Political Science from the University of Southern Maine. Kyle, I'll go ahead and turn it over to you. Thank you so much for joining us this morning.
Great. Thank you for having me. I'm going to share my screen for my presentation. Give me one moment. All right, that should be full screen. All right, so today my presentation is in 2 parts. So I'm gonna give a broad overview of economic trends. So I'm gonna be speaking from the perspective of some of the bigger macro statistics that I'm paying attention to, that a lot of lawmakers are paying attention to, and a lot of the people putting together federal budgets are paying attention to, and what they look like over the next year. And several years down the line as projected by the Congressional Budget Office. Then my second part of my presentation is I'm going to discuss some of the current tax and spending proposals that lawmakers are currently considering. And these specifically are the proposals put forth by President Joe Biden that are kind of in the early stages right now. So we don't know too much about the details, but I'll try my best in places where you may be asking questions. And then from there, we can jump into the Q&A. So the first part, an overview of economic trends. So a little bit of background here and I think everyone's quite familiar with this. I mean, it was hard to not pay attention to the economy during the pandemic. But in 2020, the pandemic caused a significant economic downturn. So GDP in quarter 2 of 2020 on an annualized basis fell by 33%. What that meant for other factors here is employment. The US economy lost 22 million jobs in 2 months during that period, and then another 25 million people left the labor force throughout the rest of 2020. So the economic performance there was pretty bad in a pretty small, short period of time. Now, as bad as it wasn't as bad as some expected. I think some major outlets, Congressional Budget Office for one, when they made projections in June or July, they were expecting things to be a lot worse and for a lot longer. But the economy happened to start to recover a lot faster than people expected, whether it was that states and localities couldn't really maintain the lockdowns and the regulations to slow the spread of virus as long as people thought they would. And maybe some people just decided, well, we're sick of this. We're just going to go back to normal sooner than we otherwise would have. So over 2020, by the end of it, roughly 60% of the lost jobs had been recovered. So a pretty quick turnaround relative to what some people expected. Now, as we're in 2021, what should we expect here? So top line, the way I think about this is it's really driven by vaccine rollout. I think that is really going to determine people's comfort levels going forward when it comes to going to restaurants, going to movie theaters, going to businesses that have been very hard hit by the pandemic. So, and looking at it, vaccine recovery, at least over the past couple months, or vaccine rollout, has been pretty fast, pretty significant, pretty impressive, especially compared to other countries. So 2021 is going to look pretty good, especially compared to 2020. But we're not going to get back to normal, and I'll define normal in a minute, for several years. That I think will one way to think about it is the economy fell rapidly. A lot of that's going to come back quickly, but then to get back to the pre-pandemic trend, or where we were prior to the pandemic, is going to take a couple of years. That last bit, or a slog to get back to pre-pandemic trend. And as I mentioned, I'll share some projections by the Congressional Budget Office just to illustrate what to expect here from a macro perspective. First, gross domestic product. So this year, GDP is supposed to grow relatively rapidly compared to the last couple of years. So 2018 was the last time GDP grew by a pretty good clip. It was 3% in real term. This year, the Congressional Budget Office is projecting that GDP will grow at 4.6% in real terms, or 6.8% in nominal terms. And a lot of that is catch-up growth, or growth, kind of lower hanging fruit, where people are coming back into the labor force. Businesses are starting to open up as the vaccine is rolling out. But as I mentioned, going back to pre-pandemic trend, it's going to be it's going to take a while. Congressional Budget Office actually projects that we're actually going to be below what they call potential output. So the economy is going to be slower than what it should be, given the amount of capital and labor in the economy, than until 2029. So it'll be a while before things are back to what CBO believes is the normal. But one thing to note here that CBO somewhat emphasizes, but I don't think other people have, that CBO seems to think that the pandemic itself kind of created a one-time hit to potential output, or sort of the size of the economy. So the economy, in CBO's mind, is going to be ever so slightly smaller for the rest of the decade than it otherwise would have been due to the pandemic, because of the hit to the economy. The businesses went under, and maybe we're just not going to get some of that back. Some of it's just going to be gone permanently. Now, in the short term, GDP fell quite significantly. jobs, millions of jobs were lost. But one statistic that I like to point to, which tells us, especially for 2020, that I think tells us a lot about 2021 and 2022, is personal income. Personal income, so GDP is defined as the market price of all goods and services sold in the United States, or produced in the United States. Personal income is the income that people earn. It also includes transfer payments that they receive from the government, minus any taxes that they pay. And one thing to note is that although GDP fell drastically during the pandemic, personal income didn't. In fact, personal income rose. That during this period, in the aggregate, total income for Americans performed quite well, and actually broke from this relationship that you usually see between GDP and personal income in a recession, where personal income will fall at the same time as GDP. And the reason for this is the robust federal government response. Paycheck Protection Program, the economic impact payments, well, the couple rounds of economic impact payments, the employer retention, the employee retention credit, the expansion to the child tax credit. All of these policies kind of replaced people's income. And for unemployed, they got the much larger and robust unemployment insurance. So even though 25 million people eventually lost their jobs, personal income in the aggregate didn't fall, it actually rose. And why is this important? Another statistic underlying this is that the personal savings rate went up drastically. And because of that, people have a lot of money stashed away. And you can kind of think about this as people are kind of sitting by and ready to spend this money. And then as the economy gets back to normal, this money is going to be searching for a place to go. And people, I think, are going to buy more goods and services. And that I think is projected to help the economy this year at the very least. And we'll get into some of the areas where I think the money is getting into that I think is also driving up prices, because one limitation on the size of the economy, or output in the economy, is the supply of labor. And that right now the labor force is still somewhat depressed, but there are still people trying to buy stuff with their higher personal income, and that's causing some prices to rise. But overall, not a huge issue, I think. And quickly, unemployment rate. So unemployment rate is projected to sharply decline this year as the economy recovers. But as I said, this is another statistic that it's going to take a couple of years to get back to normal. The gray area here, which is the projection, you're looking at getting back to pre-pandemic levels of under 4% sometime in 2026. So still, things rapidly improved, but it's going to be a little slog to get back to what people consider is normal. Prices. So this is another issue, and I think some have expressed concern on this specifically, especially given the government's response. So it was good that personal income kept pace. That meant that people that needed to pay bills were able to pay bills. Not too many people, or it limited the amount of human suffering during the pandemic. But the other side of the challenge here is that if people have money and are spending money, but there's a supply constraint, the concern is that could bid up prices and that create inflation. So people have inflation concerns. Now, Congressional Budget Office projects that the overall price level is not really going to go up all that much. So I think last quarter we saw inflation rise by more than 3%. But that was off the previous quarter where there was deflation. Prices were declining. So it's somewhat of a catch up to get back to where we were. But going forward, Congressional Budget Office doesn't think that inflation is going to be much of a concern. And I think part of that is underlying their assumptions that people are getting back to work and supply constraints are going away in short order. Now, I do want to talk about one area that's been in the headlines a bit, is that some prices have been climbing quite quickly. I mean, that's housing and related goods, lumber, construction supplies. That's an area where prices have gone up by more than 100%. And I think there's a few factors here. So there's one, the normal inflationary pressure that you would expect where people's incomes are high, but supply is low. That's going to push up demand for sort of a dwindling supply of goods. I think in some stories we've seen that, there are enough trees and there's enough demand out there for construction, but somewhere in the middle, there's just not enough supply of labor in order to process the lumber. So you get a disconnect, and that's what's bidding up prices. And that may be caused by stimulus checks or people having a lot of income and wanting to put it somewhere. I mean, the housing market is heating up quite quickly in the United States. And that's another piece too, is that the housing market, there's a somewhat strong relationship between what the Federal Reserve does with interest rates and the housing market, and that has been booming quite significantly. So I think that that's pushing the prices up too, related to those goods. So, but do those goods, is that indicative to overall price inflation? Not necessarily. I mean, the overall CPI, or consumer price index, has a lot of goods built into it. And while housing is a component of it, it's not the only component. And there are some prices that are falling as well. So, overall, the CBO projects that prices will rise, but not significantly. Now, again, I'll talk about this, but there are uncertainties with some of these projections. So I don't want to say this is definitely what will happen, but Congressional Budget Office thinks that prices will be reasonable. And then last piece, I mentioned this. So Federal Reserve they project that they're going to keep interest rates near zero through about 2023. So this is going to have an impact on interest rates across the board. But over the next decade, Congressional Budget Office projects interest rates will begin to rise at some point. This is just the 10-year Treasury note as kind of a benchmark here. And they're expecting that it would go above 3% by the end of the decade. My big caveat here is that the Congressional Budget Office, at least over the last decade, has been not all that accurate with respect to interest rates. They tend to always feel that interest rates are going to rise, but they just don't. And it could be the same case here, that interest rates may not perform the way the Congressional Budget Office is. So my prior is always to think that whatever CBO may think it rises, maybe it will rise somewhat, but maybe not as strongly as the Congressional Budget Office tends to believe here. All right, so that moving on here, because just a limit of time. So just providing an overview of Biden's tax policy and that's coming down the pike, that these policies, I think, will have some macro implications, but they're worth paying attention to because they directly impact businesses because of how the tax increases are structured. I mentioned it's early in the process, so not totally defined, but we have a good idea. And I think it's one thing to remark is that it's very similar to his campaign proposal. So it seems that he is serious about what he put forth originally. So I think that's probably what to expect broadly. So there are two spending packages out there. One's called the American Jobs Plan. You can loosely call this an infrastructure proposal. The second is the American Families Plan, and this is a plan that for benefits for families, childcare, education. And each of these packages has a set of tax increases. The American Jobs Plan is financed with corporate tax increases, almost entirely on corporations. And then the American Families Plan, that is financed entirely by individual income tax increases. And these packages are large. So about more than $4 trillion between the two of them in additional spending, and more than $3 trillion in additional taxes. Just another sense of scale here is that if all these tax increases were put in place, it would raise tax collections by about a percentage point of GDP over the next decade. And just what's motivating this? These are sort of the policy reasons behind this. They feel that high-income individuals, households are not paying their fair share. Corporations are shifting profits overseas. They're worried that corporations are offshoring, and then they're concerned also about this idea of race to the bottom, that corporations are reducing their taxes too significantly, or countries are reducing their taxes too significantly, and they'd like to bring the tax rate up across all countries. So what do we expect for corporate tax increases? They are putting forth a 28% corporate tax rate. They're going to be reforming the treatment of foreign profits, reforms to GILTI. Happy to talk about any of the details if there are questions. Eliminating the foreign-derived intangible income definition, replacing the BEAT, a minimum tax, with another provision aimed at offshoring to deny deductions for payments that are made to related foreign parties. And then a minimum tax on book income. And this would be a 15% tax that companies would pay the greater of this tax or their ordinary corporate liability, but it only applies to firms earning more than $2 billion in net income, so a very narrow tax. And again, happy to answer questions on these, just for the sake of time, kind of breezing through this. Then on the individual income tax side, going to be increasing the top individual income tax rate back up to what it was before the Tax Cuts and Jobs Act. So for single filers earning around $408,000 a year, $450,000 married filing jointly, the top will rise 30.6. Taxing capital gains as ordinary income for adjusted gross income over $1 million. So a very narrow slice of taxpayers would be paying twice as much at the margin in capital gains taxes. That's roughly equal to the tax rate on wages and salaries. And then at the same time, the death would be a realization event for capital gains. So under current law, assets passed on to heirs, the basis of those gains are stepped up, and the basis is reset at market value and passed to an heir. That would still occur, but at the same time, the gain that was unrealized during the life of those who passed away would be taxed, but it would only apply to gains over $1 million. And then apply the Medicare payroll tax to more business income. So this actually might be somewhat complicated, and they haven't put out details, but this would apply the Medicare payroll tax to more active business income. So S corporation active income would be subject to the Medicare payroll tax, or passive income rather, and some partnership income that currently escapes payroll tax would be subject to the Medicare payroll tax. And this proposal's been around for a while. And other tax increases, they're proposing to eliminate deferral on the gain of like-kind exchanges. They're going to make permanent the excess loss limitation that was passed during the Tax Cuts and Jobs Act that apply to pass-through businesses or non-corporate taxpayers. And then tax carried interest as ordinary income for taxpayers with income over $400,000. And then they also baked in some tax reductions, and this is part of their family plan, but their pandemic bill, the American Rescue Plan, had an expansion of the child tax credit, the earned income tax credit, and the child independent care tax credit. Those expansions, they would extend them. And for all of them except the child tax credit, they would be extended permanently. The child tax credit expansion would be until 2025. It's mostly a budgeting issue there. I mentioned here just the overall budgetary impact. Corporate proposals are estimated to raise between 130 to 150 billion, and then the individual proposals would be another 120 billion. One thing to note, however, the spending is a lot of the spending, especially the infrastructure spending, is temporary. But the tax increases are permanent. And I think I had a bullet point earlier to this effect that on net, these proposals, even in the first, although in the first 10 years would increase the deficit, in the long run, this would be deficit reducing because some of the spending will taper, but the tax increases would be there permanently. Just some thoughts about the passage here. They're planning on passing these through a budgetary procedure called reconciliation. And this is a complicated budget concept and it's kind of annoying to explain, but the very simple part of this is it allows passage of legislation through the Senate with a simple majority. So Democrats, they only have 50 votes. And they need every single vote in order to pass things. Reconciliation would allow them to pass legislation without any Republican votes whatsoever. But it's limited with several strict rules. And one that I think matters here is the Byrd rule, which says that anything passed through reconciliation can't increase the budget deficit in the long run. And that kind of goes back to the first point about why this is or how this is structured. The fact that it raises taxes in the long run makes it compliant with the Byrd rule. So there's a reason why they've decided to make it a net deficit reduction through tax increases that are somewhat larger than the spending. And this is something that's been done quite a few times. In the past. 2017 was the one of the latest, or at least that's how the tax bill was passed. So it's not something that is rarely used. It's actually been used quite a bit over the last 2 or 3 decades. And some concluding thoughts here. So as I mentioned, economy is projected to continue to improve this year, but there is some uncertainty. All of those projections, or none of those projections, include future policies. So it's possible that fiscal policy will be different than what the Congressional Budget Office thinks. Biden may pass all of his proposals. The taxes may have a negative, the spending may have a positive, and it could deviate from that, deviate from what CBO believes. Performance of other major economies. I think one thing that I think is a potential negative here is that other economies are not performing as well as the United States, especially parts of Europe. And that may have some impact on the United States. And the virus. I think this is the biggest question mark here. Is I think the vaccine is doing well to reduce the spread of the disease, and that's going to help the economy continue to recover. But what happens if people kind of slow down in terms of getting the vaccine, and we don't bring that level down as much as we could? That could have a negative impact on the economy, and we may not recover as fast as the Congressional Budget Office believes, or the other way around. Maybe recovery happens a lot faster, and CBO is once again wrong about, or they're too pessimistic, and the economy recovers faster. In terms of fiscal policy, it's still early in the legislative process. Lawmakers, some have already expressed concerns about the size of the tax increases, and these aren't Republicans, these are Democrats. And Democrats have expressed some concerns about the size of the corporate tax increase, and that matters a great deal. 28% corporate tax accounts for a large portion of that additional $130 billion, and if they can't get it to 28%, their proposal risks violating the Byrd rule, and it risks not passing. So I think it's the fiscal policy, or the politics of the fiscal policy, are pretty complicated. So I think in terms of the policy, nothing's set in stone, and it's still an evolving process. And the last piece here is the Biden plan does not address other fiscal policy issues. So federal debt and deficit, they are going to reduce the deficit if everything was passed on time, but they're not really talking about that. So long-term issues, Social Security, Medicare imbalance that may require taxes to go up in the future, that's going to be on top of what they're talking about. So that's something to keep in the back of your mind. And then the last piece here, I forgot a bullet point, but state and local finances. This is something that I've kind of been paying attention to, but not too much. Right now, there's not too much focus at the federal level on state and local finances. I think there's a possibility that federal lawmakers, in the context of the infrastructure package, will be transferring money to state and local governments for infrastructure financing. But in terms of fiscal response to state and local governments, I think that's another area where things are a little better than than people may have expected. I think a big concern during the pandemic is that state and local governments' revenues were going to crater. And because state and local governments cannot borrow money the same way as the federal government can, the federal government really needed to use its borrowing power to step in and plug in some of the gaps. I think in the CARES Act and other proposals, there was money transferred to state and local governments to help out. So that's a positive there. And also revenue losses weren't as significant as we may have feared, so that's good. But on the other hand, state and local governments are laying people off, and that's also a concern. That is a concern. So perhaps revenues didn't decline as significantly as they may otherwise have. States still reacted in a way to reduce the potential budgetary harm. But going forward, I think in terms of fiscal policy, it's really going to, or for state and local budgets, it's going to depend on the performance of the economy, which right now it's looking good. But also there isn't plans to do sort of blanket benefits for state and local governments. I think right now, if anything, it's going to be through the infrastructure plans. And with that, I want to make sure that I have enough time for Q&A. So with that, I will wrap up, and and also happy to talk in detail about any of these policies. I kept some of the discussion of the details to now because I didn't know exactly what people may be interested in. So if there's interest in any specific policies, I'd be happy to talk about them in length to the extent we know anything about them.
Thanks so much for that, Kyle. Really appreciate that informative presentation. It was wonderful. So like Kyle mentioned, we're going to transition over to the Q&A portion of the event. As a reminder, please use the chat function to ask Kyle your questions, and I'll do my best to work through those. I appreciate you kind of breezing through, but I did want to touch on some changes to GILTI. Can you dive into that a little bit?
Yes. So this is probably one of the more complicated one, maybe also one of the more contentious issues that. So what they're planning, they're planning three major changes to the global intangible low tax income definition of income. So first, they're going to be raising the rate. Now they haven't described in too much detail how they're going to do this, but the campaign said that the way it's going to work is they're going to reduce the deduction for GILTI. So the deduction would go from 50% to 25%. So you need to include 75% of GILTI into your taxable income every single year. Now, against a 28% tax rate, that's a 21% minimum tax on foreign profits. Second change is they would be eliminate 10% exclusion for QBI, or the qualified business asset investment. So instead of GILTI being a proposal that targets formulaically intellectual property income, it will be an overall minimum tax on all profits earned overseas. So there won't be an exemption for real activity anymore. And then the last major change is that they would, instead of GILTI being an overall minimum tax, where you add up all of your tax liability, all of your foreign profits, and then do a minimum tax calculation, instead it would be done on a country by country basis. So each country would have a GILTI tax, GILTI liability and a calculation. What this means in practice is that companies that may operate in multiple jurisdictions, some high tax, some low tax, if companies currently do not face GILTI because their overall effective tax rate is above the GILTI rate, but they have some CFCs in jurisdictions with low effective tax rates, they could be then subject to GILTI, where under current law, they're not subject to GILTI whatsoever. Some unanswered questions about the change. No discussion on how interest expenses are going to be allocated, whether they're going to address that, whether they're going to address the high tax exclusion in any way. There are some plans to maybe change that in the Senate. And no discussion on the foreign tax credit. So the foreign tax credit for the GILTI or for GILTI income has a 20% haircut. So you can only use 80 cents for every dollar in foreign taxes you pay. It's not clear whether they're going to change that to 100% or keep it at 80% or somewhere in between. This means there's a guessing game. Is the minimum tax actually 21%, or is it 26.8%, which is what would have. So this is a question that they haven't answered yet.
Awesome. Thanks for that, Kyle. Appreciate that. Another question that I'm seeing come through is you talked about that we are below potential output through 2029. What industries did we lose? How much of this is caused by lack of labor, as unemployment is still high?
Yeah, that is a good question. So there are some underlying components to that potential output, and some of it is not entirely clear to me, and it might just be Congressional Budget Office modeling and some of around their uncertainty. But I think it's also an issue of and I don't know if it's industry specific, but I think it's a couple things. It's step one, what they're showing is that the number of people that could be in the labor force has declined. And that is due to either people retiring because they no longer want to be in the workforce, and they may have retired earlier than otherwise because the economy was performing poorly, or population decline. So the CBO also believes that the population is going to be smaller than it otherwise would be. And it's just the unfortunate effect of the pandemic. And but I don't know if CBO has looked at specifically what industries are impacted by that.
Great, thanks, Kyle. Another question that I'm seeing come through, Biden has ramping up enforcement at the IRS as part of paying for his plan. Can you dive into that? Any info on what that would look like?
So there are a couple details, and one detail that's somewhat controversial and may not actually happen. So they're what they're looking to do is to increase IRS funding by around $80 billion a year, and they believe that that's going to net them $70 billion in revenue from enforcement. Now that number first is what I think is kind of a midpoint between what you could call a very, very optimistic return on investment in IRS enforcement that maybe someone like economist Larry Summers said could occur, to a more realistic or pessimistic view where CBO believes that you could only net maybe 100 or $200 billion from increased enforcement. Now, what does that mean? So policy-wise, again, they haven't put out too many details here. Hiring more people at the IRS to enforce the laws, training those people, because I think one of the big concerns about IRS funding is that over time, the amount of staff has declined, but the amount of trained staff has declined quite significantly. And auditing is not just an issue of just having people there, it's having people that are trained and know what they're doing, and that takes time to build up. So they need that investment in enforcement. And then another piece that they've put forth that there's been some discussion on is a new reporting requirement that they believe is going to work. And this reporting requirement would require banks to track withdrawals and deposits of money into bank accounts. And they believe that this will help close the gap for non-corporate business taxpayers. So it's a reporting requirement. They believe the tax gap, and estimates kind of confirm this, the tax gap is largest amongst unincorporated businesses or pass-through businesses, smaller businesses where there isn't as much third-party reporting on transactions that are going forth. So they believe that if they get this information on withdrawals and deposits to bank accounts, that they can start to close that gap. A little controversial and probably a little too broad for accomplishing that specific goal, but that is their opening bid on how they might try to close the gap and why they think they expect so much additional net revenue.
Awesome. Thanks for that, Kyle. Last question, and kind of just a summary. I know that you included some of your final thoughts, but your biggest takeaway for businesses and business leaders on the call today.
Yeah, so I would strongly emphasize paying attention to some of the details that in sort of the fiscal policy debate. And I'd pay more attention to maybe what the Senate is discussing, because that's where things are going to live or die. Biden can, the nice thing about being president is that you can propose all sorts of things, but you can't really unilaterally you can't unilaterally pass policies. So I would pay close attention to what some of the tax writing staff or tax writing committees are saying about policy, what Senator Wyden, for example, was saying about some of this stuff, what Representative Neal in the Ways and Means Committee is saying about this stuff. And those voices seem to be more moderate in general right now. So, if you want to know like what tax policy may look like in the next 2 years, I'd pay closer attention to them. And another piece here too is that if you're a business owner in the United States, it's more likely that you're a pass-through business. The Biden administration has not discussed the Section 199 Cap A yet, and I know this is probably a big deal for a lot of business people, and I didn't mention it. It's because Biden hasn't mentioned it yet. In the campaign, he did propose scaling it back for taxpayers with income over $400,000. But it hasn't been brought up yet. Now, Biden could still propose it, and lawmakers still could propose it, but it's still worth paying attention to, even though it hasn't been named yet.
Great. Thanks for that advice. Really appreciate it. And thank you, Kyle, for your time this morning and for your presentation. I appreciate you taking time out of your busy schedule to join us this morning. Thank you.
Thank you very much for inviting me.
Of course. All right, next up on our agenda, we're going to go ahead and transition into a Paycheck Protection Program update by our very own Tax and Regulatory Affairs Committee Chair, Dave Echelbarger, shareholder and managing partner of EHTC. Dave is responsible for the vision and direction of EHTC and plays a significant role in managing the business's operation and development. Dave has not only extensive tax and accounting experience, but also over 24 years of technology consulting and implementation. He serves as chair of the Michigan Association of CPAs, along with my chair, and has personally been a wealth of knowledge for me. So Dave, I'll go ahead and turn it over to you.
Thank you, Alexa. We're just going to touch on a few highlights with the PPP updates, and then a few other topics here this morning. But right now, a lot of industries or companies are going through the forgiveness, and forgiveness is in two different buckets. One is the $150,000 or less, and basically that's a quick limited information form that's needed. However, if you are in that loan of greater than $150,000, look to maximize your non-payroll expenses early on, and we'll get into the employee retention credit in a minute, but early on, it really didn't matter how we send in our forgiveness applications. Now, if possible, we want to use 60% of our loan for payroll and then 40% for the non-payroll expenditures, and we'll talk about that a little bit more in a minute. Even though you may have one of those smaller loans, the SBA is still auditing those applications, so make sure you keep everything on file in the event you're audited, so that you have all of the documentation to support your forgiveness, even though you didn't have to send it all in. So the legislation is also trying to fix the Schedule C filers retroactivity, which means early on, if you filed for the PPP and did it on net income, bottom line, back in March, they changed that to be a top line calculation. And they're still trying to fix that. But the downside of that is, unfortunately, it looks like the funds might run out in early May. There's a lot of applications out there, and some funders have stopped taking applications. And forgiveness has started picking up, but still many loans beyond the 90 days. Let's talk a little bit about the employee retention credit. A couple of things I just want to point out there, that the employee retention credit was extended in the American Rescue Plan to 12/31 of 2021. And the other thing that happened was originally in 2020, you had to choose between a PPP loan or an employee retention credit. And as of the American Rescue Plan, they made that where you could utilize that for, if you had a PPP loan, you could still go back and get the employee retention credit. So I'll just cover the employee retention credit real briefly in this next chart. So what happens here in the employee retention credit, we look at that in two different years, one in 2020, and that was a credit up to $5,000 per employee for the entire year. And you needed to have one quarter that was 50% less in gross receipts than the same quarter in 2019. There was another eligibility requirement, which basically said if you were shut down by a government order, you could also apply to this credit. The one thing to note with that eligibility requirement is it's only during the time that you were shut down. It's not during the entire quarter. That's an important part. The other part in 2020 is if you had greater than 100 employees, the credit was only available for those that were not working, that you paid, but they were not working. If you had less than 100 employees, you could take the credit even if they were working. So then we roll forward to 2021, and the credit has significantly increased. You can actually get a credit for $7,000 per quarter. And instead of having a 50% reduction, it can be a 20% reduction of gross receipts for the same quarter compared to 2019. And then they decrease the employee count, saying you would get this credit for paying employees even if they worked, if they were less than 500 employees. So that was a pretty significant change. And what we're seeing is now that the PPP activity is reduced, now companies are applying and looking at the employee retention credit. Starting, now that we're finishing up tax season here, a lot of us are looking back at 2020 and looking towards 2021 to see if we could apply with that credit. We've seen some pretty significant dollars come together for those credits for a number of companies, even though they had the PPP loans. One of the things that is really important with the employee retention credit is that the safe harbor allowing employers to use prior gross receipts to determine eligibility for the current quarter, sometimes referred to as the rebound quarter. What that means is if you qualified for the credit in the first quarter of 2021, you could start proactively taking the credit against your federal tax deposits in the second quarter. When you qualify in any one quarter, you automatically qualify in the next quarter. So that gives you 6 months with some pretty significant savings there. The other thing that's really important, and I noted earlier, was that when you're filing your PPP forgiveness application, you want to minimize your payroll dollars, because what happens is any payroll dollars on your forgiveness application up to the amount of your PPP loan are then utilized for the PPP forgiveness and not available for the employee retention credit. So I'll say that again, maybe a little bit differently. You cannot use the same payroll dollars for the PPP loan forgiveness that you're going to use for the employee retention credit. So again, if you've not submitted your PPP loan forgiveness, make sure you maximize the other expenses and minimize the payroll dollars submitted on the application. And one more comment I want to make, which is on our next slide here, which is the Family First coronavirus. What had happened is, that was a mandatory credit in 2020, basically to, help those families that had people that were sick due to COVID, taking care of somebody with COVID, taking care of families with daycare issues, school closures, all of those types of things. Now that's available as a voluntary basis for 2021. And a really important point of that is it's also available to take a credit if somebody gets the vaccine and has to recover for a day or two or longer, but that's available for recovery of vaccination. So it's something that I've seen employers offering to employees, is maybe take the day post vaccine to recover, and then the employer gets a credit for that, for allowing the employee to do that. So just wanted to point that out, something that's available to us. And with that, I will leave some time for some Q&As.
Awesome. Thanks for that, Dave. Really appreciate it. I'm going to ask you the same question that I asked Kyle, and it's really about just the biggest takeaway, the biggest advice that you have for businesses right now. I know you covered a lot of really important info, some changes too, and I do want to mention quick for the attendees before you get us our answer. The chart and the PowerPoints, I think you did a really good job as laying out the employee retention credit within the chart. The PowerPoints that you saw today will be available to attendees. I did want to make that note too. So Dave, advice.
So the big advice, again, I mentioned that, which is the PPP forgiveness. Make sure you're maximizing other expenses. And 2, start taking a look at the employee retention credit and seeing if you've had that 20% drop in any quarter in 2021. That's going to allow a pretty significant credit that's available for any business that's been hurt because of their revenue drops. The restaurant revitalization applications was opened up yesterday. That's one more point that I didn't make in the slides here, but that opened up yesterday. So if you are a restaurant or any food type of supplier, food trucks, there's a number of industries that are qualified in there. Restaurants, food trucks, I think anybody that serves alcohol. There's a number of qualifications there, but essentially what you're getting there is they're making you whole compared to your gross receipts in 2019. So if 2020 had any drop, the difference, less any PPP loans, will be is a grant that's basically given to those industries that were hardest hit. So that's my advice. Take a look at the employee retention credit this summer.
Awesome. And I appreciate you making the comment on restaurants too. I always go to you for advice, so just felt right, just to continue that, right? So I'm not seeing any other questions pop up. So thank you for joining today's discussion, Dave and Kyle. It was wonderful to have you both. This town hall has been recorded, and we will go ahead and post on our website in the coming days for attendees and those unable to tune in this morning. As always, your government affairs team is here to assist you. We will continue to keep our members up to date on the latest information as it becomes available. If you have any questions, please reach out to one of our team members. This concludes our discussion for this morning. Be well and have a wonderful week.